Okay, so now we are back into the lesson for volatility 75 index, and the lesson here is our trading strategy known as momentum strategy, which has three parts for identifying correct entry opportunities. Now we want to begin with the intraday strategy using the mini momentum strategy. And one thing that stands out in all three parts of the strategy is how average price plays out in determining the entry or the momentum that will play the most role in determining the trend of the day. So how do we find momentum, and what is a critical factor for identifying the entry price for every day? So now we have to run a test on the intraday. First, looking at the 1 hour time frame, something significant can be observed all through history of 1 hour time frame of studying volatility 75 index with respect to the momentum strategy, and that is the symbolism of average price. At every time you look at 1 hour time frame from the opening of a day, you see that the 1 o'clock candle always comes to interact with average price, and that's, if you check here, on the 24th of on the 29th of March, that was average price at 786. You see the 1 o'clock candle that follows next interacted with average price. It didn't move anywhere with that average price. Check back again at the 30th of March. 30th of March here, average price, there was one time rejection. It didn't happen this time by the 1 o'clock candle, but there was one time retest of average price. So that was by the fourth candle, so 4 o'clock candle. So the only time 1 o'clock candle did not interact with average price happened on the 30th of March. So let's look forward and see if that happened some other time again. Then look at the 31st of March. Okay, 1 o'clock candle also did not interact with average price, but still the fourth candle, still the 4 o'clock candle interacted with 8 or 9. Now we go back further to see on okay, so on this day, on the 27th of March, the 1 o'clock candle definitely interacted with average price. So we're going to explain to you how important this is. So when observed, how important is this for there to be interaction with average price? So 1 o'clock candle did not interact with average price. On the 28th of March, 1 o'clock candle did not interact with average price. So let's go forward and see. Going forward, let's see how often average price was interacted with. This was on the 29th of March. It was the fourth candle that interacted with average price. This was on the 30th of March again. The fourth candle interacted with average price. Looking again on the 1st of April, 1 o'clock candle interacted with average price. Looking at 2nd of April, the third candle interacted with average price. So that's 2 o'clock candle interacted with average price. Going to 3rd of April. Okay, 1 o'clock candle interacted with average price. So we keep moving forward and seeing how average price is interacted with in the course of the week. So going to 3rd of April, 1 o'clock candle interacted with average price. Going to 4th of April, you also see 1 o'clock candle interacted with average price. Going to 5th of April, 1 o'clock candle interacted with average price. Going to 6th of April, 1 o'clock candle interacted with average price. Going to Going to 7th of April, okay, 2 o'clock candle interacted with average price. And going further, let's see. Going to 8th of April, 1 o'clock candle interacted with average price. Going to 9th of April, there was no interaction until the 12 o'clock candle interacted with average price. Going to 10th of April, 1 o'clock candle interacted with average price. Going to 11th of April, 1 o'clock candle interacted with average price. Going to 12th of April, 1 o'clock candle interacted with average price. Going to 13th of April, 1 o'clock candle interacted with average price. Going to 14th of April, 2 o'clock candle interacted with average price. Going to 15th of April, 1 o'clock candle interacted with average price. Going to yeah, that was 15th of April, 1 o'clock candle. Going to 16th, 1 o'clock candle. Going to 17th, 1 o'clock candle. 18, 1 o'clock, okay, 18, 4 o'clock candle. 4 o'clock candle. 19, 1 o'clock candle. And we can do this as further as possible. You keep seeing an interaction with average price, so that means average price has a determining role to play in telling you the bias for the day. So average price, so the first thing you want to look out for to know what bias you should hold for the day is to identify average price for each new day. So this is for intraday strategy when trading mini momentum strategy. Now, what do you do with average price, and how or why is it important in trading the momentum strategy? Now, the simple principle here is that average price determines momentum, and momentum determines the trend of the day. So the initial momentum determines the overriding trend of the day, and average price can tell you where there will be the higher momentum for the day. So let's take a random day here. We take the 22nd of April. This was a 12 o'clock candle, the beginning of 22nd of April. And now 1 o'clock candle interacted with average price, but there was a rejection. And ordinarily, you want to trade a clear indication of a breaking of average price. You want to trade a clear indication of breaking of average price. So if you want to find the momentum for the day, whenever average price is broken, then there will be a clear trend. And when average price is not broken, then you can play a downtrend. So let's assume that you took this entry here when 1 o'clock candle interacted with average price and there was no breaking. So you have the downtrend up until here. That was 8,004 points. 8,004 points, a very short one, until average price was broken. Then you now have an uptrend starting from the 9 a.m. candle, and from average price upward, you see you could make a profit of 24,000 points. Then back to average price again by 19, that's 7 p.m. and there was that rejection you could see there in average price. And when it was broken again with a full-bodied candle, of course the day was already over. So average price on this day was rejected most often. Now you see the strong rejection consistently shows that there won't be a downtrend. But how do you know that there won't be a downtrend here? Because the first attempt there was a rejection, second attempt there was a rejection, third attempt there was a rejection. Now you often would see a downtrend when the first departure from average price produces a second candle that closes above or below the previous candle. So depending on the trend, so in a downtrend, the next candle should close with a full bodied candle below the low, or in the 2 o'clock candle, if it's in an uptrend, will close with a full bodied candle above or below the 1 o'clock candle. That's where 1 o'clock candle interacted with average price. So now 1 o'clock candle is your observation candle, and you want to find your entry when the observation candle returns to average price. So if it does not return to average price, it means you are not trading the 1 o'clock candle, you trade the 2 o'clock candle. If 2 o'clock candle does not return to average price, then you trade the 3 o'clock candle. So you only want to trade when market returns to average price and breaks average price, or rejects average price. So but typically what we see in the market here is let's see how often market rejects average price on the return to average price. So this was on the